Hello, I'm Mike Dever, founder and CEO of Brandywine Asset Management, and my two co-hosts today are Jeff Watkinson of Watkinson Capital Advisors and Eric Parnell of Great Valley Advisors Group. Hello, guys.
Hello, Mike. How are you today?
Good afternoon, Mike.
Good. We've been very active. Here at the beginning of April, we unfortunately our April 2nd. This is not an April Fool's Day broadcast because I'd have to come up with all sorts of clever things in that. But we have had since January 20th, as we all know, a pretty active slate of developments across the board that I think any small business owner, investor needs to be considering, thinking about. I don't know. What do you? I want to start maybe here with Jeff. I know that you've seen some activity in the muni bond market. What are you seeing, and what's causing it?
Well, here we are in 2025. We are on pace for record issuance, record new bonds being brought to the market. Merrill Lynch, Bank of America just raised their estimate, the annual issuance, up to $580 billion, up from $520 billion. Last year, it was a record of $508 billion of new money. Obviously, last year was an election year. The previous record was 2016. So when you have a disruptor, you have changes in policy. It seems like every state and local government is want to get their financing done before the new policy changes, trying to get grandfathered in. So that's what I'm seeing in my marketplace, a wave of new supply continuing from last year, and we're running year over year 20% higher in new deals, new issuance coming to market.
What's making that? So you say get in before new policies. What could these municipalities? I'm thinking from the standpoint of any small business owner. Are there things they should be considering that these municipalities are seeing coming down the pipeline that will affect funding, financing, through the course of this year?
Great question. I mean, I guess the tax cuts that were passed in 2017. Yeah, that was the highest issuance really since the Reagan tax cuts. So I think it's the uncertainty. Let's get out ahead of this because, it's the beginning of April. The tax cuts that were passed in 2017 are going to they sunset at the end of this year. So we're already starting to get into legislative framing, and the House has to agree with the Senate, and will the president sign what's on there? And, will this be included, that be included? The horse trading will begin. And I think the whole idea is let's do it now before it gets too crazy with headline risk and uncertainty.
Okay, so you're seeing that from the municipal standpoint. Does it apply to the small business owner that might be sitting there thinking, I'm looking at refinancing or borrowing for this new expansion or some idea that they have, they want to pull down on a credit line or get a new credit line set up, a few $100,000, $50,000, whatever it might be for them. Is that something they should be moving forward then in your mind? Or is that something that can wait until later this year? Or like these municipalities, should they be more aggressive?
That's a great question. I can't really make that determination.
Eric, do you have any thoughts on that?
Yeah, I mean, it's interesting. I think about the work that we do here at Great Valley Advisor Group in terms of building asset allocation portfolios for advisors, for their clients. And, a lot of those end clients are small business owners. And whether you're talking about investing in the markets or you're talking about investing in your business, one of the biggest things that market participants hate is uncertainty. And there has been no shortage of uncertainty that's been going on over the last couple of months. I mean, it has been head spinning. All of the different, things that are hitting the financial news headlines on a day-to-day basis. And, if you get beyond the fundamentals, because we can always return to the fundamentals and the hard data to get a sense of exactly what's going on. But when you have this steady news flow on a day-to-day basis with, okay, this is going to happen today, but well, then maybe it's not going to happen. Okay, this plan's going to go in place, but you know what? We're going to wait until next month. It becomes very difficult to make a good, clear decision in terms of how you want to allocate capital for, whether you're talking about a capital expenditure over a 3 to 5 year time period, or even some of your operational expenditures that you might be making within the next 12 months. That uncertainty makes it tough, and it makes small business owners, it makes markets inclined to say, hey, you know what, I'm going to wait a little bit and see how this falls into place before I make those decisions.
So you're seeing it actually maybe the opposite of the municipalities, where they're saying, we're going to bring this forward. We're not going to wait because we don't know what might happen, where the business owners are potentially, and maybe even investors, and making the decision that, well, maybe I do wait because I don't know what's going to happen.
Yeah, and we see it in the performance of the S&P 500. The S&P 500, the market cap weighted index itself, it peaked on February 19th. It's declined by a little over 10% peak to trough since, and it's been kind of slashing back and forth here through the remainder of March and into early April. But if you get underneath the surface of the market, we were seeing stocks correcting going all the way back to Thanksgiving, and that correction that's been taking place, it's not necessarily because of a change in what we're seeing fundamentally. The correction is actually rooted in, the uncertainty to say, okay, we don't know what all of these changes that are being talked about are actually going to mean for the markets. And we want to get some certainty around, what are taxes going to be? What's pricing going to be? What's going to happen with inflation before we make those long-term commitments?
So you say it started happening in November, but the market cap weighted index didn't start falling until February 19th. Does that mean then that a majority or a lot of the smaller stocks started selling off in November?
Yeah, absolutely. You look at the equal weighted S&P 500, where you take all 503 stocks in the S&P 500 and put an equal weight on them, or you take a look at mid caps or small caps. When we were sitting at our Thanksgiving tables back in November, that's when all those markets were peaking and started to pull back. It was because you have this super concentration at the top of the market, the Magnificent Seven stocks, Magnificent Seven and Friends, because there's a few others, that were continuing to drive to the upside. It obscured some of the weakness that had been taking place underneath the market surface for a while. It's interesting because international and emerging market investing, equity investing, they started correcting all the way back at the end of September. So there's been some foreshadowing that's been taking place in terms of some of the pullback that we've seen here over the last month and a half.
But this year to date, at least the developed international markets, non-U.S., have rallied, right? Have they actually gone up and opposite the U.S. going down?
Yeah, that's you anticipated my next point in bringing that up, because one of the things that has been interesting, the investment highway the side of the investment highway has been littered with investors that have been talking about the great value opportunity that exists in developed international or emerging markets. Look at all the value that exists there. Well, it just kept getting more attractively valued as the U.S. market continued to steam to the upside. And that's one of the interesting contrasts that we see here in 2025, is that as the U.S. stock market has struggled and kind of grinded to the downside, developed international in particular, up until recent days was up nearly 10% for the year to date. It's pulled back here the last few days, and that's because we've seen some dollar strength, because part of what drives the returns in your international investments is the currency effects, assuming you have an unhedged currency allocation, which most of us do to international markets. It's been a great year for international stocks. It's been a good year for emerging market stocks, despite what's been going on in the U.S. And that highlights that important point that's always key to keep in mind when it comes to allocating in an investment portfolio. Diversification has its benefits. It helps lower risk, and it helps to make sure that you're participating in any area of the market that might be doing well at any given point in time.
Yeah, and I think what happens, we've all seen this through our careers, I'm sure, when one sector or area underperforms, people start abandoning that. So my guess is that a lot of portfolios didn't take advantage of the opportunities they had with international equities over the last few months. If anything, they're probably allocated aggressively, to that Mag 7. One of the articles I read just 2 weeks ago, maybe, it was when Tesla had fallen 30% almost overnight. It just really collapsed to getting down maybe 40, 50%, at its trough here so far. And it was the largest inflows by retail investors into Tesla stock in history. So people would not only didn't view that as, okay, maybe I should be diversifying my portfolio because they already had high allocations there. They actually viewed it as another buying opportunity. Yeah, as every sell-off has been, for the most part, they viewed this as another one. So I guess that's left to be seen what will happen. But I think to your point, Eric, it's so important for investors to focus on maintaining that diversification, over multi-year periods. When your portfolio gets out of whack and you have a high concentration in a handful of stocks, maybe it's time to roll into some of those underperformers. Mm-hmm. Yeah, I guess I'm sorry, I cut you off there. You had
no, and I was going to say, it's true on the equity side, developed, international, emerging. It's also true on the fixed income side because, one of the areas of the market, and this is kind of, in Jeff's realm of expertise, one of the areas of the market that we've seen a lot of attractive value for some time now has been the municipal bond market. So there's so much focus on, certain areas of the market and the fact that, okay, well, corporate bonds are relatively expensive right now, and maybe high yield bonds are relatively expensive. Well, municipal bond market has been offering fairly attractive value here for some time. And that's continued into 2025.
And I know you obviously, been preaching that, for a little while now, Jeff. I mean, do you see it increasingly a nicer, better place? If somebody's looking for a fixed income allocation portion in their portfolio, at what point should they say, well, we should be increasing our allocation to munis over, say, corporates or, sovereign debt?
Thanks, Mike. March 2025 was one of the third worst monthly losses over the last decade. The other one was March 2020, which was the COVID shutdown, and the other one was March 2022. So extreme softness. Many on the street are calling this a generational opportunity to capture income. And well, where is that? Is it 2 years out, 5 years out, 15 years out? And how do you determine that? And there's a really quick ratio. You just compare the yield of a 10-year treasury AAA to a 10-year treasury to a 10-year AAA municipal bond. And it's called the muni to treasury ratio. And if that ratio of the municipal yield is above 80%, munis are considered cheap. They're really considered rich, expensive if they're below 80%. If they get below 60%, they're really considered rich, because you think of that highest tax earner, their federal income tax plus the Medicare surcharge. You're looking at 40% plus. 100 minus 40 is 60%. But we are seeing now.
So what you're saying there is essentially, if at 60%, they're equivalent. You could buy, if you're in the highest tax bracket, you could buy a muni and net out the same return as you would get in a corporate after paying taxes.
Exactly. We're seeing ratios now, if you go out 15, 20, 25 years, above 90% for a AAA rated GO versus a 25-year, 30-year treasury.
Which means somebody in the highest tax bracket might be getting 20 or 30% more interest on the muni after tax than buying a corporate.
You're getting significantly more interest, and you might even attract something called crossover buyers, which will buy a municipal over a treasury, even without the tax benefit. So that's how out of whack things have gotten. And like I said, all this supply came into the market January, February, and there was enough demand to meet it. And then in March, the demand softened up. And March is seasonally a weak month in municipal bond land for a couple of reasons. January is usually a very firm market because bonds mature, interest is paid January 1st, they're looking for a new home. All these desks, all these departments that do public finance, they don't really crank up until mid-January, so there's no homes, a lot of capital looking for homes, so they bid up prices in the secondary market to allocate. Now we get to March, some people have to sell municipal bonds to meet their April 15th tax bill. They're more reluctant to allocate capital to a municipal bond or anything when they have a tax bill coming up. Will that continue after April 15th? That remains to be seen. But and there's been outflows in ETFs and mutual funds in the municipal bond space 3 straight weeks. So demand has softened, supply is still there, and they have to make the prices lower, yields higher, more attractive to attract buyers.
Yeah, it sounds like what you're pointing out is that if you were at all considering muni bonds, or if you're considering even fixed income, and you don't even need to be in the highest tax bracket, you can be in sort of a middle income tax bracket and benefit by being in a muni bond today over a corporate.
That's a great way of boiling it down. Yes,
right. Okay,
I'll throw in 1 or 2 more points. I know I'm talking Jeff's area of expertise here.
Come on in.
And I know I just got through talking about developed international and emerging and the virtues of investing outside of the U.S. But a big priority for a lot of investors here in this country is, you want to buy local, buy USA. No better way in your investment portfolio to invest in the local and regional communities across this country than to go out and buy municipal bonds. And the depth and breadth of bonds that exist out there in the municipal space is tremendous. And that's where somebody like Jeff comes into play in terms of his area of expertise, is because that marketplace is so vast and has all these different moving parts. Those active managers in that space like Jeff, they're going to be able to get in there and identify, okay, what are the good values and what are the good opportunities? What are the new issuance that are coming to marketplace, to be able to express that investment view of, say, hey, I want to do my part to make these local communities across the country, be able to grow and flourish in the future.
That's an interesting way to look at it. It's you've got the altruistic approach. I generally view investing as, I just want to make money, but I'm sure there are some people who aren't just as, a greedy bastard like me, and they want to make, good at the same time. Now we have a question here, our viewer question, and it kind of hits this same kind of concept of, where do you go today, with all this turmoil and things going on, and muni bonds might be a safer haven potentially, certainly with their yield right now. But we have a question here from Mary Robbins of Philadelphia, Eric, that I'd like to direct to you. It's,
sure.
What are some defensive investments that I can buy for the long term that have a dividend?
Mary, this is a great question, and it's a great time to ask this question because, we've been talking about how the S&P 500, the U.S. stock market, has been in correction so far this year, particularly since February 19th. And when you take a closer look at what's been going on with this correction, the pullback has been concentrated in technology stocks and consumer discretionary stocks, which is a fancy way of saying Amazon and Tesla. So, and most of these stocks are not big dividend payers, the ones that have been correcting lately. But if you get underneath the surface of the market and underneath the surface of the S&P 500 and getting to that point of diversification, one of the things that we see, and it's kind of surprising to a lot of people, is that there's many areas of the market that are doing well. And what areas are doing best right now? It's those dividend payers that you're talking about. And where do you find them? In the consumer staples space. So consumer staples, we're talking about household products companies. When you go to the grocery store and shampoo and laundry detergent, you're also talking about food companies also at the grocery store. The different food that we eat every single day. Many of those companies very stable in terms of their earnings, and they generate great dividends. We also see this in the healthcare sector, where pharmaceutical companies or medical supply companies. And we also see this with electric utilities that pay big dividends. All 3 of these sectors, despite the fact that the S&P 500 is down year to date, all 3 of these sectors are higher by more than 4% through the end of the first quarter. So, even though the headline market might not be doing well, the stocks that you're interested in buying are the ones that have been doing great so far here in 2025.
Hey, thanks, Eric. And I'm going to come back to that. But for right now, we're going to take a quick break for people to learn how to send their questions in to Money Matters TV.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS,
Very good. Thank you. So, I did want to get back to that question on the dividend. So what is a good dividend yield right now? What are some of these stocks in these three sectors that you talk about that are up at least 4% this month? What are they yielding?
Yeah, that's a great question, because when it comes to dividend investing and looking for yield in stocks, there's a sweet spot that you want to focus on. Because if the yield is too low, well, it's not satisfying that yield demand. And if the yield is too high, then you can start to delve into some stocks or securities that are pretty risky, because there is no free lunch. If there's a high yield, it needs to be funded in order to be paid that out. So an ideal yield typically for a stock is something that's yielding anywhere in the range between 2% to 4%. That's where you're tending to find your best yields. But there's an added wrinkle to it too that's important to note. It's not just about the yield itself, but it's also about whether the company can continue to grow their dividend over time. So when looking for companies that pay dividends, it's not just about the high yield, is do they have a long-term track record of increasing that dividend over time? Because we want to keep up with inflation, and we want to see that dividend stream for our investments continue to grow over time.
So you're not just getting a decent yield from the dividend, you're getting and compounding on that. You're taking advantage of the earnings growth and compounding the growth of the dividend over time as well.
Yes, getting a chunk of the profits that the company's making every year. So if they're growing their profits, then they can sustain paying out that high dividend over a long period of time.
And if you do that long enough, you're just like Warren Buffett, and you're booking tens of billions of dollars in dividends every year.
Yeah, absolutely. He loves his dividends. He's done pretty well too. So
those have paid off for him. Now, do you see, Jeff? Is there competition with dividend stocks for the yield you're getting?
I love dividend growing stocks. I mean,
okay,
it's consistent, and you think about a dividend. Where do dividends come from? They come from earnings, a profitable business, and dividend checks and distributions don't bounce. So there has to be legitimate earnings, and the companies that raise their dividend year over year are returning more capital back to the shareholder. And I can't echo what Eric said enough. Growing dividends year over year comes from earnings and the companies that have done it the longest or are growing at a higher rate year over year with their dividend growth, it shows that it's a healthy business, and especially through different business cycles. How long have they been growing that dividend? And there has to be, like Eric said, I mean, delayed gratification can be a huge benefit for the investor. So I like the stability, I like the consistency, and dividend growing companies give me, just like municipal bonds, peace of mind and predictability.
Now, back on the risk side for a second, are we seeing what I mentioned earlier about individual investors, retail investors going in aggressively into Tesla during this last sell-off? Is there reason behind that makes sense, that's logical, that from a long-term view, do you think, Eric, pays off? Or is this a stand back and let's see what happens? Is it an opportunity, or is it a sort of a false allure here, a little moth to a flame?
No, that's a great question, Mike, because, there's so much that's going on, and there's, we hear a lot of soft news out there. Investors are worried about inflation. People are worried about a recession. One of the things that I used to always like to say when I was a college professor is do your own homework. And that had nothing to do with the assignments that I was putting out there. It had to do more with the analysis that the students were doing. Because you're going to hear a lot of things that are swirling around in the financial news or in the mainstream news at any given point in time. But the key is to always go in and verify the things that you're hearing and go and take a look at the hard data. Because more often than not, the hard data will tell you the truth. And when going in and taking a look right now, we see economic growth forecasts for the United States continue to remain strong and north of 2%, at least for the first and second quarter of 2025. Whether it's actually realized remains to be seen. We talk about inflation. We see inflation, 5-year break-even inflation expectations remain at about 2.5, 2.6%, which is, from my view, a sweet spot for inflation to be over a long-term period of time. And then you look at corporate earnings that we were talking about before to support those dividend growth stocks. According to S&P Global, the makers of the S&P 500, who aggregate those profit forecasts for the 500 stocks in the S&P 500, they're forecasting double-digit earnings growth for 2025. All of those factors are strong fundamentals that support the potential for higher stock prices through the remainder of the year.
Okay. All right. So don't panic. The market's down 10%. It's not something that we need to be overly concerned with. Just sort of stay the course. To kind of summarize a little bit, yield's not bad. We've got some great yield opportunities today in the markets, and portfolio diversification and continuing to maintain balance in the portfolio. Anything you guys would want to add to that sort of summary of what we've covered here today?
I got one thing to add. You go ahead,
Jeff.
I think the news and the headlines we're going to see they're going to continue. Whether it's through this year or the foreseeable future, there's always going to be something. And municipal bonds are the second safest asset class behind U.S. Treasuries in terms of credit. And I think it was Warren Buffett who said, don't bet against the United States. And, obviously diversification matters, but those are my final comments on this. I mean, you have to ignore the noise and do what Eric said. Do your own homework.
Mm-hmm.
And I'll build on Jeff's great points to say we're in a correction right now since the middle of February. Corrections happen. It's a healthy thing to happen in markets. Markets aren't supposed to go straight up. It's 3 steps forward, 1 step back. We're in a step back right now, and that those pullbacks provide good buying opportunities.
All right. Well, very good. Thank you, Jeff. Thank you, Eric. Once again, you guys, you do a great show. I really appreciate it, and all your insights on that.
Thank you, Mike.
Thank you. So our next guest on Money Matters TV is Vahan Dajigian, PhD, CIO of Greenwich Wealth Management. Thank you for watching Money Matters TV, where your money matters. See you next time.